So yesterday, I'm talking to my dad. He just got off the phone with his financial advisor, who he is paying 1.25% assets under management, which means for no matter how big the portfolio is, if it's growing, if it's shrinking, he's paying this dude 1.25%. And from my dad's frustration, I could tell he wasn't exactly killing it. So I knew that there was going to be a problem. He hangs up the phone, he's a little bit upset, and he's like, I can't believe I'm paying these guys thousands of dollars per year and they're getting me just average returns. And I was like, well, Dad, 88% of advisors do not beat passive index funds. So if 88% of the dudes aren't beating the market, why are people still paying their advisor these crazy fees? $7,000, $10,000, $20,000 depending on how big your portfolio is. Well, I don't know. In my dad's case, he was not getting the performance he needed and he's paying way more than he should be. So we talked after he hung up the phone. I said, I'll do some research. I'll look into some ETFs, really low cost. And I know that my 3-fund portfolio can do at least 12.5%. We're going to find out the best ETFs today over the last 10 years, over the last 5 years, and then the best bang for the buck ETFs over the last year. And we're going to see if they beat the 3-fund portfolio, or at least can they beat my dad's advisor. Let's find out.
Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. Let's get into it.
So these first ETFs are selected based on their total return over the past 10 years. It's going to exclude leveraged funds and inverse funds. And the list is going to prioritize funds with high liquidity and strong performance. Number 7 is the Vanguard Information Technology ETF, VGT. Its 10-year return is 203.8% with an expense ratio of 0.09. It's going to track the market cap weighted index of the U.S. information technology companies. So it's going to have all sorts of different small caps, mid caps, and large cap. Coming in at number 6 is the iShares U.S. Tech Fund, IYW. 10-year return 204% and an expense ratio of 0.4%. Tracks the Russell 1000 technology capped index and focuses primarily on U.S. tech companies. Number 5, Technology Selects Sector Spider Fund, XLK. 10-year return 207% with an expense of 0.09%. It's tracking the S&P 500 tech stocks, so you're going to see a lot of weight towards large cap firms. Number 4, the Spider S&P Semiconductor ETF, XSD, is a 10-year return of 216% with an expense ratio of 0.35, and it's tracking equal weighted index on semiconductor stocks across different market cap size. Number 3, Invesco Dynamic Semiconductor, PSI is the ticker. 10-year return, get this, 240% with an expense of 0.57. It uses a quantitative model to select U.S. semiconductor companies, tilting towards growth firms. Number 2, iShares Semiconductor ETF, there's a theme, ticker symbol SOXX. We got a 10-year return of 253%, an expense ratio of 0.35, and it's tracking the modified mid-cap weighted 30 largest semiconductor companies. But number 1 of the 10-year returns is the VanEck Semiconductor SMH, shaking my head because this 10-year return is 272%. It's got an expense ratio of 0.35 and it's tracking the market cap weighted index of the largest U.S. semiconductor companies. Obviously a big benefit from AI and the tech demand. So over the last 10 years, you had plenty of great returns if you'd been in tech heavy stuff, semiconductor specifically, and you were just crushing it if you got that last VanEck fund. But what happens if we break it down the last 5 years? Will semiconductors still be the trade, or has something bigger been on the horizon? In fact, think about it real quick, last 5 years, what's been going on? If you have a guess, put your guess in the comments below. I'd love to hear from you. By the way, if you are new here, my name is Nick, and I am a former investment advisor. I'm the co-author of an investing book called The Quick Start Guide to Investing. And at 42, I retired to spend more time with my 2 young sons and their mom. The channel explores, the reason for this channel is it explores my investment research as I am fully on my own. I am living off my dividend portfolio and my weekly options trades. So if you want to learn along with me, subscribe and let's get it on. Wait, that sounded weird. Let's move on. Now, these next ETFs, looking at the last 5 years, are going to be based on total return, excluding leverage and inverse ETFs, and it's going to focus on sustainable performance. Number 7, the SPDR S&P 500 Metals and Mining, XME is the ticker. 5-year return 246%, expense ratio 0.35, and this is tracking U.S. metals and mining companies. Number 6, First Trust RBA American Industrial Renaissance ETF, that's a mouthful, AIRR, 5-year return 264%, expense ratio of 0.7, and this is looking at the industrial community capitalizing on infrastructure growth. Number 5, the VanEck Semiconductor SMH, still doing great. 5-year return 268, expense ratio still 0.35, again tracking the semiconductors. Number 4, First Trust Natural Gas, interesting. FCG is the ticker, its 5-year return 284%. Expense ratio is 0.6%, it's tracking U.S. natural gas producers and energy growth. Number 3, the Sprott Uranium Miners, ticker URNM, 5-year return 292%. Expense ratio is a little high, but you are looking at an industry that is very niche. Number 2 is going to be similar. It's the Global X Uranium ETF, ticker URA, 5-year return over 307%, expense ratio 0.69, and this is looking at global uranium and nuclear energy companies. But was data the big boy? Was AI the big boy? Is nuclear energy the number one of the last 5 years? Nope, it's the Grayscale Bitcoin Trust GBTC with a 5-year return of 973%. However, it's got a huge expense ratio of 1.5%. Crypto is decentralized money, right? So why are you paying so much for Bitcoin in an ETF? I get it if you want it in your 401k or your IRA, and you can't really get into a cold wallet. But if you're talking about a taxable account, I recommend just buying Bitcoin on your own through one of the big firms out there. Don't pay 1.5% for a Bitcoin ETF. However, 973%, dang, Bitcoin is crushing it. So over the last 10 years, tech and semiconductors were where it was at. Zooming in the last 5 years, we see Bitcoin, we see precious metals, we see other commodities like natural gas. But let's zoom in one more time. And let's look at the top 7 ETFs by management fee versus return. Think of this as like the best bang for your buck. This is going to show you what 7 ETFs give you the best returns for the best value. And coming in at number 7, Vanguard FTSE Developed Markets, ticker symbol VEA. Its 1-year return is 19.7. Its expense ratio is 0.03%, and it tracks developed markets outside the United States. Number 6 for bang for your buck is the iShares MSCI EAFE, which is IEFA ticker. Again, same index, it's up 19.7. Its expense ratio is 0.07, tracking big markets, not including US and Canada. Number 5 is the Vanguard Tech ETF, VGT. 1-year return, almost 37%. Expense is still at the 0.09. Again, tracking the US tech industry. Man, that puppy's doing great. Number 4, we got the SPDR S&P 500, the OG, ticker symbol SPY. Return is 23.7%. Expense is 0.09. It's the oldest S&P 500 ETF. It's highly liquid. It's the one you want to choose if you're trading options. Number 3 is the Schwab US Large Cap SCHX. 1-year return, same as the other one, 23.7, but a cheaper expense ratio, 0.03. And look, the next 2 are going to be very similar. iShares Core S&P 500, ticker symbol IVV. Same return, 23.7. Same expense, 0.03. Again, another one tracking S&P 500. But the top dog for the best bang for your buck, OG at number 1, the Vanguard S&P 500 ETF, ticker symbol VOO. 1-year return, 23.7. Expense ratio, 0.03%. You're getting great market matching returns from Vanguard, one of the best in the industry to do it. It's giving you broad US market exposure with ultra low expense ratio. There you have it. 3 different groups of ETFs. Most of them, as we would probably guess, were beating the actively managed people. There's very few people, and I'm not picking on my dad's guy, there's very few active managers that can beat the indexes or that can beat specifically focused ETFs. You saw the last 10 years, AI is a huge trend. Semiconductors is a huge trend. Energy is a huge trend. And Bitcoin is a huge trend. The other fifth thing you see is that low-cost passive indexes that track the S&P 500 are going to be consistent winners. Like imagine paying somebody $7,000 to $10,000 to manage your $500,000 to $1 million portfolio, and then realizing you could have done that with the S&P 500 for a couple $100. Yeah, that's why this channel exists. That's why I've retired early and I'm doing this for myself, because I want to find the best bang for the buck for myself. And when I find it, I'll let you know as well. Thanks for joining me today. I hope you got something out of today's episode. I do this every Sunday night on 15 Minute Money so that we can learn together. We'll see you next week.
Thanks for joining me today on 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.